Good morning, all. I hope you are well. So, I have just the one pair on watch today. That is Aussie Yen. The market across the board looking to me like it needs a little bit more development, which is exactly what I would expect leading into Christmas. What I've noticed is that the longer I've been trading, you can kind of tell. I'm not always familiar with when bank holidays are actually coming up. Obviously, I am familiar with when Christmas is coming up, but for the most part, I don't really keep track on when bank holidays are coming up. But a lot of the time, what I've found as I've become a little bit more experienced is you can kind of tell when a bank holiday is coming up just by the price action. Okay, it looks like it's going to be range bound for a little bit of time, which is often what happens leading into a bank holiday, and Christmas seems to be no exception. And one of the other things that I've noticed, since I've got a bit more time on today's video to speak a bit more about various things, one thing I've noticed is when the Forex market looks like it's going to be range bound for a little bit, what you'll often find is if you go into the commodities, you'll find that a lot of those will be in key areas and vice versa. Okay, so when Forex looks like it's going to commit, I already know a lot of the time before I start looking at commodities, when I create my watch lists over the weekend, I already know that a lot of those are going to be range bound without even looking. And I think that's got a lot to do with money being transferred. Okay, wealthy people are not just pulling their money out of things, they're not just putting their money into things, they're rotating it. Okay, so that would make contextual sense as to why when one asset class is range bound, the other one's in a key value area and vice versa. But without further ado, let's break this pair down for you today. And I think my hunch is that the same is going to happen with Aussie Yen. It's just going to be range bound until after Christmas, but it's that kind of thinking. It reminds me of the story of the tortoise and the hare. It's that kind of thinking, falling asleep on the job, so to speak, which is why people miss trades a lot of the time. So even if we think that, we must still show up the same way regardless, as if there's going to be opportunities, because the market can change very quickly, as I'm sure even if you're a newer trader you have experienced. But Aussie Yen, let's break this down on the higher time frames. So the narrative as I see it is we had what according to my data was an all-time high. We near missed to that area. Okay, we moved down correctively. So this is Falcon 101. We have this kind of three-touch structure there. We have the middle section, okay, with the 1, 2, 3 in it, and then we move up to that area. The last part of the move has aggression. We break just above, and then we move to the downside aggressively. Okay, so there's no need at this moment in time for price to come all the way back up to there. So that gives me that's the first kind of confluence factor for a short bias. We then have this impulse correction, potential continuation to the downside. I like the fact that the last monthly close was very bearish with no wick below it, but a big wick above, suggesting a washout of liquidity. I like the fact that we have a near miss to that low, which we will likely take out. Okay, and if we just measure that from there to there, and we assume that the continuation leg is of a similar length, that will give us that 1, 2, 3 down to that area, which will make contextual sense. We have pulled back quite a distance. Okay, so we have pulled back over 50%, but a lot of this is likely volatility, because if we just drill down, you can see there's a big wick. The more time frames you see a big wick on, the more likely that a lot of this was just volatility. Okay, because if we measured this and we ignore that wick, if we're now deciding that it's volatility, that takes us almost to down there to bang on where the measurement, I would anticipate the measurement lining up, and that makes sense because that was the origin of all of this volume that was built there. Okay, so just building the story, we have this correction here. This is slightly strange when you get an impulse up, a correction, and then an impulse down after a move like that. But again, I'm just seeing this as a bit of profit taking after such an aggressive move down. And the other confluence factor is that, so we've had all of this correction here, we've dropped out of that now, so I'm seeing this is an impulse correction continuation within this impulse correction continuation. And if we just drill down a little bit further, you can see that we actually tapped into something of significance. We had volume here built where there was a big runoff, and we tapped into that by way of a reversal structure, okay, with the middle section there, 2 near misses. This breaks above that, but fails to tap into that. The third touch does, and then we move down, although not immediately, okay? People think when these things happen, when we have something like that, it's just going to do that, okay? It doesn't always happen like that. We often get a move down. We often pull back about 50% of the length for that and then drop, okay? And that's what happened in this instance. So as I drill down, you can see that after we broke out, the reason I've got this on here is because this line here represents the origin, the base, of all of this, okay? And after we dropped out aggressively below here, price left a little footprint, okay? And if we just zoom down, so this is a prime example of what we deem a wick fill, okay? So when we have an aggressive move like that, and notice we wick 2, none of this wicks through this area of value, okay? That's a good indication to me that regardless of how good the lower time frames look, we will likely come back up to fill this wick and tap into this area and likely break above before moving to the downside, especially when this footprint and this candle here, which wicked to the area, especially when it didn't tap into the base of all of this volume here, and especially there's something else I was going to touch on. I can't remember what it was. Especially that's what it was. Especially when we have the subsequent candle after this bullish candle is an indecisive red candle like this. Okay, so we pull back a little bit, but look how much wick is below there, and we also didn't pull back 50% of the length of this candle. So all of these confluence factors together are making me think that this is a trap to trap the sellers in too early before we come back up, fill this wick, likely break above here, and likely tap into the retest to the back end of this, okay? And the clue for me is you can see it's not committing, okay? We've had quite a lot of, this candle in particular is quite an indecisive one, and now this is getting quite wide relative to the move down which has preceded it, okay? So this correction here is getting quite wide, okay? For something so early on into the move, I wouldn't anticipate something like this. And I wouldn't be surprised, although I'm going to be looking for a tap into this area, which was where this volume was generated, okay? Although I'm looking for that, I wouldn't be surprised if, because we're leading into Christmas, this just goes sideways or even does something like that. We get something like that, and then we come back up. Okay, that wouldn't surprise me at all. But just in case price does that, okay, in one candle, which could happen, what I'm going to be looking for today from this pair is I'm looking for specifically a break above this area of value, which would likely retest the back end of all of that, as I mentioned. And then I'll be looking for a 1 hour impulse back down, and then either a 5-minute or a 15-minute continuation. And then I'll be able to manage it down to this low for 3%, something in the region of 3. And I would set the take profit there, because if we measure this range, whoops, I don't know why that happens so much with TradingView, but measure from there to there, the 90% area is where price can pull back deeply. Even if it's going to continue in the forecasted direction, it will often pull back 50% of the move, which would be, if you just eyeball this, that would be about 4 or 5%. So I would set a take profit there rather than sit through potentially deep corrections, and that would give us something in the region of 9.5%. And then I would trail my stop loss at the same time. So I have an alert set at the area of value. If that does not trigger, I'm not interested in placing a trade on this pair today, and I shall wait. I will probably do another video tomorrow, but it's very unlikely that I'll be placing a trade tomorrow. And if I do place one tomorrow, then I will be in and out very quickly, because I won't be holding it over Christmas due to potential gapping and all that kind of stuff. And that is what I'm going to be looking for today, folks. I hope you've enjoyed this video. I thought I'd go into a little bit more detail from a kind of fundamental perspective at the beginning. But have a great day, folks, and I will see you again in tomorrow's video. Thanks for watching.